Welcome back to the Deep Dive. We're kicking things off today with, well, a genuinely surprising story. A real success, actually.
Oh, yeah.
Yeah, it seems the South African auto market has punched right through a ceiling that's been there for a decade.
Okay, interesting.
According to the latest TransUnion Mobility Insights report, new passenger sales just soared. We're talking a massive 22.5% year-on-year jump in Q2 2025.
22.5%. That is big.
It is. These are the strongest sales numbers the market's seen since way back in 2014.
Wow. Okay.
So our mission today is to dive into this report, really unpack the complex forces behind this momentum. Because, while the home market's booming, it's definitely not all clear sailing ahead. There's some pretty serious headwinds we need to talk about, things that could potentially stall this whole recovery.
And fragile is absolutely the word we need to keep in mind here. That's what the report suggests.
Right. Fragile recovery.
Yeah, this momentum is real, but it seems driven by some very specific, maybe short-term factors, market corrections, policy effects. But the long-term picture still looks pretty uncertain.
Got it.
So we've basically boiled the analysis down to three key themes that tell this story. First, the macro stuff, the shifts that actually help put money back in people's pockets.
Okay.
Second, the big competitive shakeup, new brands coming in and changing the game.
Right, the value players.
Exactly. And third, this kind of split reality, strong domestic sales on one hand, but worrying weakness in exports on the other.
Okay, let's start with that surge in volume then.
Right.
Pushing past 35,000 units. That hasn't happened in ages.
Yeah.
What exactly was the economic cocktail here? What brought us back to 2014 levels so fast?
Yeah, it wasn't just one single thing. It was more like a convergence of factors. Specific supportive macro shifts, really all aimed at making cars more affordable and borrowing cheaper.
Makes sense.
The report highlights three core things that gave this powerful but maybe short-term boost.
Okay, what are they?
Firstly, monetary policy. That played a huge role.
Yeah.
The South African Reserve Bank cut interest rates 5 times since September 2024.
5 times. Wow.
Yeah. That dramatically lowers the monthly payments for anyone needing finance, right?
It was. Okay, what's number 2?
Secondly, inflation gave households a bit of breathing room. It came back down into the lower end of that target band, the 3 to 6% range.
Always helps. And the third factor?
The third one is affordability, driven by the industry itself. We saw record low new vehicle inflation and, crucially, some really aggressive financial incentives from the OEMs.
The manufacturers themselves.
Exactly. The big global car makers were pushing deals hard.
Okay, so cheaper money, less general price pressure, and the cars themselves getting relatively cheaper or having big incentives slapped on them. Sounds like a winning combo.
It does, but
I have to ask, if the economy's fundamentally looking better, why the need for such heavy incentives from manufacturers? Doesn't that hint that maybe the underlying consumer base is still, struggling a bit?
that is the critical nuance the report really digs into. Yes, consumer confidence has improved quite a bit.
Okay.
But that improvement, it's heavily skewed towards the middle and higher income groups.
Oh, right.
If you look at lower income consumers, they're still feeling intense pressure. Think high food costs, electricity prices. Those haven't gone away.
So the incentives were needed to bridge that gap for many buyers.
Precisely. They were needed to lure those buyers back into the market, confirming that, well, not everyone's feeling flush, despite positive headline numbers.
That focus on affordability,
Yeah.
it leads us perfectly into the next big shift, the competitive one.
Right. This is where things get really interesting, isn't it? The market structure itself seems to be getting turned on its head.
Absolutely.
We're seeing this rapid, almost aggressive expansion of new brands, mostly focused on value, and they're just reshaping everything.
You said it. The numbers for the Chinese automakers in particular are genuinely staggering.
Yeah. Give us the figures.
Okay, so their market share. It leaped from just 3.1% back in 2022.
To nearly 15% in the second quarter of this year, 2025.
15% in just 3 years. That's incredible growth.
It's blistering, just phenomenal speed.
So is that purely down to price, just being cheaper? Or is there more to it? Like, have their dealer networks and maybe the perception of quality caught up that fast?
It's a mix, definitely. But the foundation is absolutely value. They're offering affordable SUVs, packed with tech, which is exactly what buyers everywhere seem to want right now.
The sweet spot.
Right. And they're backing it up by rapidly expanding their dealer networks. That builds trust, makes them more accessible.
And this must be putting huge pressure on the established guys.
Oh, massively. This is forcing the legacy OEMs, the ones who've been here for decades, to really rethink their entire playbook. We're talking pricing, what features come as standard, even how quickly they refresh their models. They have to react to stay competitive.
But amidst all this disruption, the old guard hasn't vanished. Toyota, the report says, still holds the top spot overall.
Correct. Toyota remains number one, almost perennially, it seems. But the interesting part is Suzuki. They've locked down a solid second place, and this is the second quarter in a row they've done it.
Second place 2 quarters running.
Yeah.
So that really underlines the point about value, doesn't it?
It confirms exactly what consumers are prioritizing right now. Value for money, efficiency. People want more car for less cash, basically.
And connecting this back to you, listening right now, whether you're in the market for a new car or maybe a used one, this whole surge really highlights just how powerful value and, frankly, aggressive affordability are for South African buyers at this moment.
Yeah, that pressure is really dictating who's winning and who's losing market share. And this focus on affordability brings us to another, maybe slightly counterintuitive divergence we're seeing. It's between new and used vehicle demand.
Okay, how's that playing out? Because used versus new is often a good barometer of how people are feeling financially, right?
Exactly. So if we look at the official registration data, the Natus figures new car registrations shot up 20% year on year in Q2. Impressive, especially strong in places like the Northern Cape, Free State.
20% up for new. Huh.
But in sharp contrast, used vehicle registrations actually dipped. They declined by 1.4%.
Declined. But wait, if affordability is key, wouldn't you expect more people to be pushed into the used market? That feels backwards.
It does seem a bit counterintuitive on the surface.
So how does that crucial used-to-new vehicle registration ratio look now? That usually tells the story.
Right. Well, the ratio did rise quarter on quarter. It went up to 3.2 used cars registered for every new one in Q2, compared to 2.5 in Q1.
Okay, so used still dominates overall volume.
Absolutely. The used market is still much bigger. But, and this is the key point, that 3.2 ratio, it's still way below the 3.8 ratio we were seeing through most of 2024.
Okay, so compared to last year, new cars have actually clawed back some ground against used.
Exactly. It suggests that maybe some buyers who could afford new, perhaps at the slightly higher end, were more active this quarter. It highlights that shifting spending capacity.
Now, you mentioned liquidity earlier. We absolutely cannot talk about liquidity in the South African market right now without bringing up the two-pot factor.
Definitely not.
That retirement reform from September 2024 clearly put cash in people's hands. And the report says it directly impacted car buying. For listeners maybe just catching up, can you briefly explain what the two-pot system is and, well, what did that cash actually end up buying?
Sure, that's vital context. So the two-pot reform essentially allows people to access a portion of their retirement savings early before they actually retire.
Right, a pre-retirement withdrawal.
Exactly. It basically provided an immediate, maybe unexpected cash injection for consumers, particularly those feeling financially strained.
And the impact on car sales.
Well, the report is quite nuanced here. It seems the amounts people withdrew were generally not enough to cover the full deposit needed for a brand new car.
Okay, so it wasn't funding high-end purchases.
No, definitely not driving sales of top-spec SUVs or sedans. Instead, this money seems to have provided really meaningful support, acting as a catalyst, actually, for incremental used vehicle purchases.
So it helped people get over the line in the used market.
Precisely. It provided that crucial cash boost for those affordability-driven buyers, especially in the entry-level and mid-market used segments.
And the data on who is actually claiming this money is fascinating, too.
Yeah, we can see some really clear trends there. Millennials think age 29 to 44, and also younger Gen X, maybe 18 to 28. They are by far the most active claimants.
Interesting. And older groups.
Baby boomers. They're withdrawing much less, relatively minimally. But maybe the most telling behavioral insight here is this. Repeat withdrawals are becoming more common.
Wait, repeat withdrawals? So people are going back for more?
It seems so.
That's not just a one-off boost then, is it? That sounds like evidence of ongoing financial pressure.
It certainly suggests that.
It implies this mechanism is becoming almost a recurring source of liquidity, specifically for those entry-level vehicle buys. Supporting consumers who maybe need that regular cash injection just to stay mobile, that feels like a pretty significant structural change.
It absolutely could be. And it really highlights the potential vulnerability of that core buying segment, doesn't it?
Okay, so the domestic picture is Well, it's complicated, driven by affordability, policy effects like two-pot, and these disruptive new brands. But even with this domestic spending happening, I imagine the big manufacturers, the ones with the factories here, must be looking nervously over their shoulder. What's the biggest external threat the report flags? The one that could impact local jobs and future investment.
Yeah, the contrast is stark. The biggest immediate threat is a pretty severe external shock hitting exports. They slumped dramatically.
Exactly.
While the local market was celebrating that 22.5% increase in sales, South Africa's passenger vehicle exports actually fell by a staggering 24.6% in Q2 2025.
Fell by almost 25%. Ouch! What's causing that?
It looks like a double whammy, partly just general softer global demand, economy is slowing elsewhere.
Like,
But the major headline grabber here is the introduction of new U.S. tariffs. We're talking tariffs of up to 30% on vehicles exported there.
30%. That's huge. And that presumably hits certain types of vehicles harder than others?
Absolutely. This pressure is falling heavily on the premium models, the ones that are built locally, often by the German brands or Ford, but rely almost entirely on selling into the lucrative U.S. and European markets.
So that raises really serious questions, doesn't it?
Yeah.
About production volumes here, local jobs in those factories, and maybe even future foreign investment if those export markets become less viable.
Exactly. You can have a booming domestic market for, say, affordable Chinese SUVs, but if the major factories can't export their traditional premium models profitably, the long-term health of the entire manufacturing base is at risk. It's a major concern.
So how does the report see things panning out? What's the outlook?
Well, reflecting this instability, the outlook suggests this current domestic growth surge is likely to moderate, probably quite substantially heading into 2026.
Why the slowdown?
The reasons are pretty clear. Interest rates are expected to stay relatively high for a while longer. Credit conditions will likely tighten up as lenders get maybe a bit more cautious managing risk.
Makes sense.
And that temporary boost from the two-pot withdrawals, that liquidity effect will naturally fade or normalize over time.
Right. It can't last forever.
Exactly. Then you add in those persistent export risks we just discussed, plus the usual rand volatility. It all adds up to a recipe for significant uncertainty looking ahead.
Okay, so for the players in the industry we're talking, the manufacturers, the dealers, the banks, and finance houses,
Yeah.
how do you even manage this really fragile balance between grabbing the domestic opportunity while hedging against that serious external risk? It sounds tricky.
It is tricky, but the report does lay out 4 pretty clear strategic directives for navigating this complex environment.
All right, let's hear them.
First up is timing. This is crucial. The industry needs to think beyond just standard seasonal campaigns. They need to strategically align their promotions, their marketing pushes, even their inventory, with known consumer liquidity cycles.
You mean like timing offers around when people might be making those two-pot withdrawals?
Exactly that. Plan specific offers to capture that cash injection right when it hits consumer bank accounts. Be ready for it.
Clever. Okay, what's next?
Second, affordability has to remain front and center. It's the core driver right now. So that means really focusing on those value brands, pushing certified pre-owned CPO vehicles hard, and actively marketing models based on their total cost of ownership.
Because buyers are watching every rand.
Every single rand. They need to see demonstrable value over the life of the vehicle.
And that focus on affordability must tie directly into how people actually pay for the car, right? Financing.
It does. That's the third strategy. Evolving financing solutions. Lenders need to get creative, offer innovative products designed to lower those barriers to entry.
Like what specifically?
Things like deposit support programs, maybe trade-in boosters to give people more for their old car, flexible repayment terms, anything that makes the monthly payment more manageable.
But that sounds potentially risky for the lenders too.
It can be, which is why, while doing that, they absolutely must leverage data to carefully monitor repayment behavior. They need to manage that post-purchase risk very effectively.
Which leads perfectly to the last point, I'm guessing.
It does. Finally, the industry has got to fully embrace data. Using advanced data-driven insights is no longer optional. It's critical.
How so?
By integrating different data sources, credit bureau info, registration analytics, you can better identify those liquidity-sensitive buyers, the ones potentially using two-pot funds. You can pre-approve customers more quickly, track real-world repayment performance.
Get a much clearer picture of the actual risk and opportunity.
Exactly. That kind of sophisticated data use is really the only way to sustainably grow sales in what is, let's face it, a pretty high-risk environment right now.
This has been a really fascinating deep dive. A market finding its feet, but facing some serious challenges.
Definitely a mixed bag.
So just to recap for everyone listening, South Africa's auto market has definitely found some momentum. That 22.5% surge is real evidence. But it's clear this is a highly strategic game at the moment.
Very calculated.
Yeah, the growth is almost entirely driven by aggressive affordability, the huge structural impact of those value brands, especially from China, and these timely, perhaps temporary policy effects like the two-pot reform. But the external picture, particularly those export slumps and the new tariffs, casts a pretty long shadow over the long-term outlook.
It really does. And that leaves us with a final, maybe slightly provocative thought for you to chew on.
Okay, let's hear it.
Given what we've seen, particularly the data showing key buying segments, millennials, younger Gen X becoming increasingly reliant on repeat two-pot withdrawals for their vehicle purchases, well, how dependent has the immediate health of the crucial entry-level market actually become on this mechanism?
Is it propping things up more than we realize?
Is the two-pot system now functioning as a genuinely sustainable feature supporting the market? Or is it really just a recurring temporary fix that's masking deeper, persistent financial strain among those core buyers?
A temporary fix or a new reality? Something to definitely think about as we watch how this fragile recovery unfolds. Thanks for diving deep with us today.
My pleasure.
We'll catch you next time.